It's scary to invest your first $1,000, but today I got 6 ways for you to do it. The first one will sound boring, but it's really important. Paying off debt. Don't worry, I got some amazing options coming after this one. Let's say you went on these amazing vacations with your friend, you went to the bar, to expensive hotels, and to the casino where you lost so much money. Don't hide behind, I can see you. Maybe you use your credit card quite a bit. Let's say that you now have $1,000 in credit card debt. And just to let you know, credit cards have a super high interest. Yes, the average credit card interest is about 15% in the US. Now, if you compare that to what you usually get into the stock market, it's about 7 to 8% when you speak about the S&P 500, which we'll speak about later in the video. You really want to pay it off before you start investing. Here is why. For example, as I said, you have $1,000 in credit card debt and you have to pay it back. But as I said, you have a 15% interest on it, which means that on top of this $1,000, you should also pay $150. Now, if you invested this $1,000 into the stock market, as I said, it's around 7% return, you will get $70 out of it. So with your credit card debt, you will still have about $80 to pay back. So you are better off paying off every high interest debt that you have before even thinking about investing. And then only the amazing part will come. Now that this is out of the way, let's go into the juicy investments that you can do. The next 5 ways of investing your money will all be into the stock market, so stay until the end, you don't want to miss the best strategies. At the end of every single investment that I will present to you, I will give you a few examples of stocks that you might buy. Okay, so in the stock market, there are a few different ways of investing your money. The first one that we'll discuss is mutual funds. A mutual fund is an individual company that you want to invest in. Let's say you want to invest into Apple, that's a mutual fund. You want to invest into Nikola, don't do it. But that's still a mutual fund. So when you're buying mutual funds, you have actually many different choices that you can make. So the first investment, and one of my favorite, is Dividend Stocks. As you probably know if you saw my latest video about how to start investing, dividends are an amazing way to make passive income streams. You are literally getting paid to be holding onto a stock. When a company pays you dividend, it means they are taking away profits of the company and giving it back to shareholders. So it means that most of the time, dividend companies are actually profitable, except if they're having a lot of issues, but that's an exception. Because a company that is not making profit and paying dividends means that they are going into debt to pay dividends, which you don't want to do. That's a really bad sign for this company. So since these companies are giving away profit, it means they're already profitable, so the company is already well established. So it's a really safe investment to make because they already have everything set for success. Now there has to be a downside when it comes to dividend investing, right? Well, yes, as with all investment strategies, there is always a downside to it. So what are they for dividend stocks? A dividend stocks usually will give you less returns when it comes to share price increase. And it makes complete sense if you think about it, since the company is already well established. For them to grow more than like 10% per year is super difficult, since they have almost everything figured out. But on the other hand, they pay you this really safe and stable return that is the dividend. So another advantage is that if the company's stock price is not moving up or down, it's stagnating, then you are still making money because the company is still paying you this dividend. Next amazing thing about dividends that made me choose this strategy over others is that you can make your money compound itself. What does it mean, you ask me? Well, let me explain you. Let's say you get paid a 4% dividend each year by holding into a company. When you get paid, you take it and you reinvest it into either this company that just paid your dividend or another company that also pays a dividend. This way, the next time you'll get paid this dividend, it will be slightly increased because you have more money invested into the stock. And when you do that over a long period of time, you will see an exponential growth when it comes to dividend payments. So this is an amazing way over the long term to make massive amount of money. And don't forget, it will start pretty slowly and increase really rapidly over time. Some of the best dividend stocks that I would recommend would be AT&T, PepsiCo, Johnson & Johnson, or 3M. These are all great companies. They pay the dividend for multiple years and they increase it every year for multiple decades in sometimes. So they are really safe and great investments to do. But again, you probably won't make massive profits when it comes to share price increase because they are paying this dividend and they have less way to grow than other companies. Speaking of which, the second investment that you can make with your first $1,000 is into growth stocks. In this case, your goal is to have an increase in value of the share price and set it at a profit. So once again, you should have a really long-term view when you invest into growth stocks, just like dividends. One of the most important part of investing into growth stocks is that you should understand what you are buying. You want to understand the company, their business, how they are making their money, and you want to make sure that over a really long period of time, this company will still be around and still growing. The best way to do so is to ensure yourself that you are investing into companies that are really innovative and are always growing their products or services. A few examples could be Apple, Tesla, Nvidia, Microsoft. All these companies have great products or services, and they are growing a lot. Now that you find those great companies, the next thing you do is that you dollar cost average. So dollar cost averaging means that you are buying over multiple occasions, and why would you not want to put all your money at once? Because don't forget that when you put money into a stock, there is still risk involved. It might as well go down in the future. So if I had $1,000 to invest into growth stocks at the moment, what I would do is that I would slowly over time buy myself into these companies. Maybe like $100 each week, so I could buy it into multiple weeks or even month if I have to. So that will ensure your investment to be safer since it can't crash at once, since you still have money for yourself to buy if there's a dip. And also something else that you have to do, and that's for every single investment strategy, is that you have to diversify your investments. So you don't only want to buy into one company, but rather multiple companies so that you're sure that if one crashes, your portfolio will not go down. Okay, so why did I say that you need to invest into the long term if you invest into growth stocks? Because you can make profit over the short term, right? Well, yes, but the market on the short term is super unpredictable. You never know what's going to happen the next day. So as long as you have a view of 10 plus years, that can go up to 25 years if you want to, and you know that these companies will do well in the future, well, you are fine to invest into these companies. But over the short term, you never know what's going to happen. If you don't have this mindset, it's going to be really hard for you to invest into growth stocks and make the right choices. Also, something great with growth stocks is that you can technically invest into thousands of different stocks. Yes, there's almost an infinite amount of stocks that you can buy from that can all be considered growth stocks. And as I said, some good example of growth stocks will be Apple, Nvidia, Netflix, Microsoft, and all these big like tech sector companies. Next investment is great in my opinion because you can actually invest in real estate into the stock market. That sounds strange, right? But let me explain you. A REIT is a real estate investment trust. In other words, it's a company that owns a lot of real estate that you can invest in. So this company will use the investors' money to buy more real estate, and they are getting paid back by tenants and other ways of making money by real estates. And some of those REITs actually are owning the places where big corporations are using, like Walmart and a lot of big businesses like these. And the way they are paying back investors is by having a really volatile dividend. Some REITs actually pay back all their profit back to investors in the form of dividend. So in good quarters, you can make massive amount of money, and in bad quarters, you can make small amount of money or no money. Now, when it comes to REITs, it's almost like you are investing into real estate without all the bad things about it. So it means that you can say to someone that you are investing into properties by just owning one share of a REIT. And the good side of it, as I said, is that you don't have all the negative stuff about owning real estates, like annoying tenants, reparation costs, etc. So it's a great opportunity to start investing. So as I said, they pay some really great dividends and also have some stock price increase over time. So you are not really focusing on dividends or growth stocks, but you have those two aspects into one. Of course, as I said, the dividend is more volatile since it really depends on the profit of the company, but most of the time it's pretty high. One of the great aspects about REITs is that some of them actually pay monthly dividend like realty income, which is awesome because by owning this company, it's almost like you are getting a small salary every month. Because if you don't know, companies that pay a dividend mostly pay it every quarter, but realty income, for example, pays it monthly. If I should recommend any REITs, I would go to Realty Income and Store Capital. I own these two companies and they're pretty great. Now, if you are feeling uncomfortable about putting money into the market, I got a great solution for you with this fourth investment, that is bonds. It is a more conservative approach to investing, but it's also really safe. A bond is actually another investment that I see less and less people speaking about or even investing into these. Because bonds most of the time actually have less return than other ways of investing. But on the other hand, it's super safe to invest into these. So the way bonds work is that you, the investor, is giving money to either a company or you can even do it to the government. And then over time they will pay you back with interest. It's like if you are doing a loan to the government or a loan to a company. So you can see why it's safe, because if you give money to the government and they can't pay you back, well, you probably have bigger problems than this. So as I said, really safe, lower returns. And also since the pandemic started, I see less people actually using bonds because most of the time bonds can't actually really compete with the rate of inflation. So I can't really give you the best bonds that you can buy, but in the description of the video there's a link that you can go and check out all the bonds that you might want to buy. Now, last investment, but probably my favorite one out of all of these, is index fund investing. First off, what is an index fund? So it's pretty much a basket that regroups multiple stocks. So what's so special about it? Well, listen carefully because you can actually passively invest into an index fund and become a millionaire. Well, the way they work is pretty much a bundle of stocks that you can buy at once and have ownership of all the companies that's inside. So what are the benefits of index funds? Well, as I said, it's an amazing opportunity for people that wants to start investing to actually buy one thing and not worrying about buying mutual funds, researching stocks, or even being worried about your investments, because it's pretty much automated. Let's take probably the most known one, the S&P 500, that regroups the 500 publicly traded most performing companies of the USA. It has been shown in so many studies that the S&P 500 actually outperforms about 90% of mutual fund investors over a long period of time. It is the most amazing way of diversifying your investment, which makes it even safer. So as I said, it's really cool because it pretty much guarantees you that by investing into it, you are pretty much making 7 to 8% return each year. And it also pays a dividend, which you know I like for the compound interest of it. It's the most passive way of investing with bonds maybe, because you can buy it and come back in 20 years and have a ton of money. That's because the S&P 500 can't really fail, since it's not an individual companies, but rather 500 of the most performing companies of the US. Now, is there negatives when it comes to index fund investing? There are a few, but honestly, not that much. First thing that most people say is that it's boring to invest into index funds, which I can understand because you don't have the adrenaline of buying a stock and not knowing if it will go down or up in the future, because you're pretty much guaranteed to make profit. But you know, it's boring but profitable, so I don't mind. There's also something called an expense ratio, which is a fee that you'll have to pay for the people that are managing actually this fund. And don't worry too much, the fee is ridiculously low. For example, if we take the one that I invest in, which is the VUSA, which is following the S&P 500, is only about 0.06% per year. So it's so low that it's almost unnoticeable. And in my opinion, if you're paying a fee for someone to manage over 500 companies, it's pretty fair, since you also don't have to manage it yourself. So in my opinion, you should be okay paying this small fee because you are pretty much paying someone to do the hard job of taking companies out of the fund because they are outperforming and adding new ones. By consistently investing into an index fund, you are setting yourself for the future, and that's for sure, which is why I recommend this investment to anyone. Now that you know where to put your money, go and watch this video about the mistakes that you should absolutely avoid when you start investing. Of course, subscribe for more personal finance content like this one, and I'll see you in the next one. Bye bye.